Hello, and welcome back to the Mochi Panda Club. Today we're going to talk about understanding your credit score and credit report. This is an important aspect of financial literacy, as a good credit score can open many doors, such as getting approved for a mortgage, credit card, or loan. On the other hand, a bad credit score can make it difficult to get approved for credit, and you may end up paying higher interest rates if you are approved. So what is a credit score? A credit score is a 3-digit number that ranges from 300 to 850, and is based on information from your credit report. The score is generated by a credit bureau, which is a company that collects information about your credit history. There are 3 major credit bureaus in the United States: Experian, Equifax, and TransUnion. A credit score is calculated using a complex algorithm that takes into account many factors, such as payment history, outstanding debt, and credit history length. Your payment history is the most important factor that affects your credit score, and the longer the history, the more the impact. It's important to know your credit score and monitor it regularly. You can get a free credit report from the major credit bureaus once a year. You can also use free online tools to check your score more frequently. Pay your bills on time. Your payment history is one of the most important factors of determining your credit score, so it's crucial that you pay your bills on time. Late or missed payments can have a negative impact on your credit score. Keep your credit card balances low. High credit card balances can have a negative impact on your credit score, so try to keep your balances low. Ideally, you should aim to keep your credit card balances below 30% of your original limit. Don't open up too many new credit accounts at once. Opening too many new credit accounts in a short period of time can be a red flag for lenders and lower your credit score. Try to limit the number of new credit accounts you open. Dispute errors. If you find errors on your credit report, dispute them with the credit bureau. This can help improve the credit score and ensure that the information on your credit report is accurate. Use credit wisely. Using credit wisely is the key to maintaining a good credit score. Avoid maxing out your credit cards and try to pay your bills in full each month and avoid paying interest. Avoid paying too much credit. Every time you apply for credit, it generates a hard inquiry on your credit report, which can temporarily lower your credit score. Try to limit the number of credit applications you submit, especially if you're not sure you will be approved. By following these practices, you can help improve your credit score and use credit effectively to meet your financial goals. Now, I have to say, I've had a very storied journey when it comes to my credit. When I started really worrying about my credit, I was already at least a 534 credit score. Yeah, I was really irresponsible with my credit. I didn't really care. It was kind of a YOLO type of a thing for the course of many years. I defaulted on loans. I defaulted on banks. I had to go to court a few times to rectify a lot of that. And yeah, it's really not worth it to look back on the things that I bought, which a lot of times you buy so much BS on a credit card that you can't even really picture what you bought, why you bought it, and all that. My credit score now is amazing. I have very good credit now. The high 700s, and it only got that way through a lot of hard work, intentional, dedicated, ritualistic work. I'd say one mistake that I made when attempting to fix my credit was that I deleted even the good standing credit and credit cards that I had. I wiped all of it off of my credit report. And looking back on it, yes, that was a big mistake, because as I grew to learn, your length of credit history is a very important factor in your credit score. So keeping your old accounts that are in good standing will only help improve your score over time. And if you have a mix of different things, not just credit cards, but a few credit cards, a car loan, a mortgage, will all improve your overall credit score, if they're all in good standing, that is. I think one of the things that woke me up to wanting to get my credit together was the fact that many, many years ago, I tried out for a job that they asked for my background information. They wanted to run a credit check and all these other things. And I wasn't even thinking about it. I'm like, well, of course my credit is horrible, but that shouldn't be a determining factor of whether I got a job or not. But no, I didn't get the job, and the reason given was because I didn't pass the background check. And since I didn't have anything bad on my record other than my credit, I had to assume that that was the reason. And yeah, it haunted me so much because the opportunity at the time seemed really awesome. And it's like, wow, man, I really missed out on this job because of a credit score? It was just unfathomable to me. So I went on a crusade to fix and repair my credit. For me, it was something that, if given the opportunity, would never happen again. You won't turn me down because of my credit. How to fix your credit. First, check your reports. The first step in repairing your credit is to get a copy of your credit report from all three major credit bureaus, Equifax, Experian, and TransUnion. You can request a free copy of your credit report once a year at annualcreditreport.com. Review your credit report carefully and look for any errors or discrepancies that may be damaging your credit score. If you find any errors, contact the credit bureau and the creditor to dispute the information. Next, pay your bills on time. Payment history is the most important factor in your credit score, so it's important to pay all your bills on time. Set up automatic payments if you need to, and consider using a credit card with a low interest rate to pay off high interest debt. Reduce your credit card balances. High balances on credit cards can hurt your credit score, so it's important that you pay down your balances as much as possible. Aim to keep your credit card balances below 30% of your credit limit. If you have multiple credit cards, focus on paying off the card with the highest interest rate first. Don't open or close credit accounts unnecessarily. Every time you open a new credit account and close an old one, it can affect your credit score. Avoid opening new credit accounts unless you absolutely need them, and be careful about closing old accounts. As you work to repair your credit, it's important to continue to use credit responsibly. This means paying your bills on time, keeping your credit card balances low, and avoid maxing out your credit cards. By using credit responsibly, you'll be able to build a positive credit history and improve your credit score over time. Now let's talk about credit reports. A credit report is a detailed summary of your credit history, which includes information such as your payment history, outstanding debts, and credit inquiries. It's important to review your credit report periodically to make sure that the information is accurate, because errors can happen and it can affect your credit score and credit opportunities. One way to monitor your credit score and credit report is by signing up for a free credit monitoring service, which will alert you to any changes on your report. Another way is to check your credit score and credit report for free at annualcreditreport.com. In summary, understanding your credit score and credit report is an important part of financial literacy. A good credit score can open many doors. A good credit report can help you get the best credit terms. So take the time to learn about your credit score and credit report and use that information to make smart financial decisions. Okay, so I think you got a lot of information so far. So let's test that. It's quiz time. How many digits are in your credit score? Is it 1, 2, or 3? The answer is 3. Why were credit scores originally not disclosed to consumers? Was it too confusing? Was it to ensure its accuracy? Or was it to save money? It was too confusing. Without an explanation of what it means and what creditors want, the score is just an incomprehensible number. When did credit scores first become available to consumers in the United States? Was it 1989, 1999, or 2001? The answer is 2001. Consumer rights organizations and even the U.S. Congress pressured the credit reporting agencies to disclose this previously secret information. What does the term FICO stand for? Is it the Fair Isaac Corporation, the Financial Investigation Commentary, or Fixed Income Credit Organization? The answer is the Fair Isaac Corporation. Fair Isaac Corporation was the company that developed the credit score used by the major credit bureaus. How many U.S. credit bureaus are there? Is it 2, 3, or 5? The answer is 3. 3 major credit bureaus in the United States. They're named Experian, Equifax, and TransUnion. What is the range of FICO credit scores? Is it 0 to 100? Is it 1 to 500? Or is it 300 to 850? The answer is 300 to 850. The score is drawn from various facts that are written on your credit report, weighted via a proprietary formula. What aspect of your credit report weighs most heavily in determining your credit rating? Is it payment history, outstanding debt, cash on deposit? The answer is payment history. Since credit scores are most used to determine the likelihood that you'll repay a debt, it is logical that payment history would be the most important element of that score. At what percentage of your available credit should you ideally keep in your credit card accounts? Is it 25% or less? Is it 0.4? Or is it 0.65? Well, the answer is 25% or less. The smaller the percentage of your available credit that remains unpaid at any given time, the worse your credit score will be. Why does a longer credit history translate into a higher credit score? Is it because more information means greater accuracy? Is it because you have more time to lower your outstanding debts? Or is it because it indicates greater financial responsibility? The answer is because more information means greater accuracy. Lenders are not looking to weed out as many potential customers as possible. They simply want to have an accurate picture of your reliability as a borrower. What's a soft inquiry on your credit report? Is it checking your own score? Is it multiple inquiries by different lenders within a short span of time? Or is it a request of credit below $1,000? And the answer is checking your own score. Hard inquiries are those by lenders investigating your credit and negatively affect your score for a short time. Soft inquiries do not affect your credit rating. And lastly, if you have multiple different types of credit accounts, what effect will that have on your credit score? Is it positive, negative, or neutral? The answer is it will have a positive effect. You will be considered a less risky borrower if you have positive experience with different types of loans rather than just one. Thank you, and that's the end of the quiz. Now, these questions were a sample selection from How Stuff Works Ultimate Credit Score Quiz. I suggest you check it out. You can play the rest of the quiz and see how well you do. Okay, so that wraps up our episode on credit scores and credit reports. Remember, your credit score and credit report are important indicators of your financial health and can impact your ability to obtain credit and loans in the future. By monitoring your credit report regularly, paying your bills on time, and maintaining a low credit utilization rate, you can improve your credit score and increase your chances of getting approved for credit in the future. We hope that you found this episode informative and helpful. If you have any questions or topics you'd like to cover in future episodes, please let us know. And as always, thank you for tuning in to the Mochi Panda Club. And don't forget to like and subscribe if you found this video helpful or useful.